Welcome to the daily insights that matter. Sensex and Nifty have ended their 9 consecutive days of rally and slumped yesterday below 60,000 and 17,700 levels respectively. While there were quite a few factors, let's try to decode and understand the reason for the slump in the markets. The first and the major reason for the fall was the disappointing earnings of Infosys, which missed all parameters in its fourth quarter. Infosys missed its revenues, its earnings before interest and tax, net profit, and margins in comparison to the estimates. Infosys declined 10%, leading to the broader index also falling as the IT sector has a close to 15% weightage in the index. Additionally, the Nifty IT index was dragged lower as TCS also posted weak earnings. It looks like fiscal year 24 would be a year of revenue growth disappointment as there are multiple economic headwinds which could challenge growth and the ability to maintain margins. The next factor was the anticipation of a Fed rate hike. The markets around the globe keenly wait for how the world's most developed economy hints on further monetary policy tightening. Inflation in the US is at 5% currently, which is still well above the tolerance band of 2%. And to contain this, the Fed would most likely raise the interest rates again when they meet at 2nd May. This was also another factor that dented the sentiment in the Indian markets. It has been a difficult year that has been marred by sharp inflation, rising interest rate amid the Russia-Ukraine war. The impact of monetary policy tightening by central banks around the world has given rise to global recessionary fears. Though India has the least probability of recession, the impact of recession or any recessionary fears would affect the Indian economy. As per IMF, India will grow at 5.9% for the fiscal year 24, which is still one of the fastest growing economies in the world. The next story is the wholesale price index cooling down to a 29th month low. To fully understand the data, it is important to distinguish between WPI and CPI. WPI calculates the average change in wholesale price for goods, while CPI calculates the average change in retail prices for goods and services. WPI focuses only on changes in the price of goods, while CPI takes into account changes in the price of both goods and services. To summarize this, WPI gives more weight to manufactured goods, where CPI gives more weight to food items. WPI in India had remained in double digits for several months. This was mostly driven by a rise in commodities propelled by the Russia-Ukraine war. However, WPI slowed to a 29th month low and recorded an annual 1.3%. WPI inflation was recorded at 3.85% in the previous month and 14.63% in March 2020. For fiscal year 23, the wholesale inflation averaged about 9.4%, moderating from a 30-year high of 13% in fiscal year 2022. The decline was on the back of a favorable base effect and due to moderation in the prices of manufactured products. Although India's wholesale price index based inflation rate fell to a 29-month low of 1.3% in March, and consumer inflation also dropped below the central bank's 6% tolerance limit, indicating low price pressures, this was mainly due to a favorable base effect. Nevertheless, the outlook does hint a relief, especially with WPI dropping to a 29-month low. So what does all of these news mean for you? India is expected to be one of the fastest growing economies in the world. The underlying fundamentals and growth prospects of India are strong, and the short-term headwinds will have a minor impact on the country's long-term outlook. This will have an indirect, neutral impact on you. The WPI March reading of 1.3% is a sharp decline from a peak of 16.63% in April, which is encouraging for the Indian economy and the markets. This news will have an indirect positive impact on you. While I say this is me, Rahul Hassan, signing off. Have a great day and stay safe.
Did you like watching this video? Then download our app, Informed Investor, to watch more such informative and interesting videos.